Right. Hello, everyone. Hey, Suja. Welcome.
Hey, Tate.
Just got to send Ryan this link real quick. How are you, Suja? Good morning.
Doing well, thanks, Tate. Yeah, excited to have this Q&A. I know there's some exciting news on the property or the deal.
There is. Yeah, it looks like we've identified a fourth asset. So excited to talk about that, and then any other questions people might have in terms of the project itself. Things are off to a really great start. One of the things I'm so excited about this one is we're coming in at the 11th hour here when dirt's already being pushed and foundations are being poured, and yeah, it's a really fun time to be coming into the portfolio. So
Yeah, it's great timing for us for sure.
We give Ryan a few more minutes here. He is on the way. In the meantime, if anybody is on the call and you have any questions that you'd like us to talk about and answer on this call, please throw them in the chat, and we'll get around to those.
Do you want to just, while we're waiting for Ryan, just do a quick intro on you and I, Tate?
Yeah, that would be great. Suja, you want to go ahead?
Yeah, so my name is Suja Sham with Lux Capital Investment Group. Tate and I are partnering on this deal to bring capital to the Diversified Storage Growth Fund, which our chosen operator is Spartan Investment Group. We have a long-standing relationship with them. We've invested in several deals with them and really seen them just do amazing things, particularly when it comes to expanding and developing self-storage, and they're just fetching amazing prices for the expansions and the new developments that they've had. So it's a really great way to diversify any commercial real estate portfolio right now, which is one of the reasons we're so excited about it. We just recently had an exit with them of 1 out of 5 properties in a portfolio, and we were, after 3 years, able to return 100% of investor capital, as well as an additional return, about 5%, and we're still going to be cash flowing, and now the projections look really great. So, so very excited to be partnering with them on this deal because I think it's similar in nature.
Of course, you have to unmute, right? Yeah, the deal that Suja is referring to is our Tyler Longview portfolio, which was about 36 months ago that we invested with that. That's one of 5 deals that we have partnered with Spartan on, just as a capital raise, a capital firm. I have a lot of experience with Spartan outside of that as well, and yeah, that was a portfolio of 5 with some heavy value add and expansion components, very similar to this, and yeah, we've sold off one of the 5 assets for a full return of investor capital, while still cash flowing and still growing that portfolio with the remaining assets. And here's the man himself.
How you going?
Thanks for joining us.
Thanks,
Excellent.
Tate. Hey, Suja.
Little Zoom update.
Hey, Ryan.
Yeah, of course. Like right when you click on the Zoom link, there's an update. So
yeah, it happened to me as well.
Oh, thanks. So you could have done that any other time, but right when you're trying to join a webinar. So,
hey, no problem. But hey, thanks for joining.
Thanks for having
me. Let me kick it off to you. I'm just going to. There we are. Let me kick it off to you and just sort of ask for an update. We have investors that have already remitted funds and are in the deal, and so can we just get sort of a historical view of what the project has looked like throughout the year and up until now, and then sort of where we're at currently, and then we'll go into where we're going.
Yeah, no, I really appreciate the opportunity to talk about it. We have started building P Ridge. We're actually almost done with that property. It's going to deliver the new units at the end of the year, which is fantastic. So when you think about investing in a fund that produces a return as high as this one, I think you guys are projecting 22% annual return. It usually means that you're taking on a lot of risk and that there's, more upside because of the returns that you're projected. But these properties have really de-risked in the sense that we've already got the buildings built at P Ridge. So we're really just going through the final stages of getting those turned over to our operations team and starting leasing those units up, which is fantastic. On the Bellevue side, our Bellevue site has broken ground. I actually was there just the day before Thanksgiving. I had a chance to walk through that property. But that news is even stale because we're now pouring foundations. So at the time I was there, we had the building staked, we were pushing dirt, we were well under construction, but now we're actually pouring foundations for the first 6 buildings that are going up. And I thought that project was going to deliver in September of next year, but it's actually delivering in May of next year. So it's delivering 4 or 5 months early, which is fantastic. So that pulls up the timelines on everything. The nice thing about those 2 projects is we already know what we're going to spend. We already know we're under budget on those projects, very slightly, maybe less than 1% under budget. So there's no risk in building costs increasing. We've already ordered all the metal and materials. We already have those properties locked up. On the Kingsland property, the third one that I wanted to talk about, we're already 50% leased now. So I think I remember the last time we checked in, we were maybe 20 or 30% leased. Now we're 50% leased on that asset. So we bought that property from a contractor, and he hadn't turned it on yet. He hadn't gotten it operational, but we kind of took it over, got it online, brand new building, and we've got that facility now 50% leased, which is incredible. So when you think about these properties, they're really far along in the process, and it's just a great time to invest as we wrap up the fund and grab the last couple properties in it. So.
And that the Kingsland lease up, can we speak to that a little bit? Because for people that aren't familiar with how fast or how slowly storage facilities usually lease up, I mean, that's a huge execution risk, is lease up risk, that we talk about all the time on webinars. Once we build the thing, we actually have to get renters in there. And so that's been since August, right?
Yeah, so we opened in mid-August, and usually we'll see about 25 to 30% per year in a lease up of a facility. So obviously in these just 4 short months, we've gotten it half leased, which is very fast. And that's not only impressive from the standpoint of just sort of an industry average, but this is the slowest time of the year for self-storage. This is when people are doing holiday shopping, kids are in school, people don't move in the winter typically. So that just shows the demand of the market is really strong, and it's underserved by self-storage. So the fact that we've leased up 50% in 4 months, in the worst time of the year, when the economy has been kind of a little bit slower, is really telling to the strength of that property. As we round the corner into the new year, we actually start our leasing season in late Q1. That's when we're really going to see a spike in move-ins, because that's usually when people are moving. Here's the other thing I want to talk about with self-storage too. I don't know. I was talking to another companion in the industry, and I call it what's the self-storage freight train that's coming. So my personal opinion, and we haven't underwritten this at all, we've been very conservative in how we've leased this up, but as an industry, in the United States or in the world, really, we're kind of heading for a recession. I think if we aren't already are in one, we're heading into one. And I think what's really interesting about recessions, if you look over the last 80 years, the average interest rate decrease during a recession, the average has been 5%, or about 508 basis points. The lowest decrease in interest rates that we've had during a recession has been 1.68%, or 168 basis points. So if you think about it, the interest rates have always fallen during a recession, and the smallest decrease has been about 1.68. Now, if you think we're going into a recession, I tend to agree that we are. The interest rates are going to come down. They always have for the last 80 years. That's my theory. Well, storage has kind of been flat as of late because people aren't moving, right? I mean, I read but an interesting article in the Journal about 3 days ago saying that people are getting divorced and they're not even moving out, right? So people are getting divorced and they're not even moving because the interest rate is so expensive, they can't go buy a house, they can't go move. And so when you think about home sales being down, you think about kind of people being sort of in place and not on the move. That's created a little bit more of a flat industry for us. We've seen more move outs, less move ins. Storage is still doing very well as an industry, but we're seeing it kind of slow right now. And so if you think about it, if interest rates go down and home buying starts picking up in the new year, and all those moves that have been otherwise put on hold for the time being, you're going to have this massive lease up season next year. And it's just incredibly timely for our facilities that are delivering in the new year. So when you think about, the P Ridge units are coming online, the Kingsland property is already online, the Bellevue property delivering in the perfect time of the year, which is May, which is right when our leasing season starts. Basically Memorial Day to just a little bit after, just a little bit before Labor Day is our leasing season. We're going to be delivering those units right when everybody is kind of like getting back to moving potentially. And I think there's going to be a significant amount of pent up demand because people, couldn't transact, couldn't move as much as they could in recent time in the last year. So I think the deliveries are good timing. But just wanted to provide that 2 cents on where I think kind of the industry is at right now.
That's amazing. Ryan, I also want to touch on the fact that, storage pricing has remained really strong in terms of asset prices. And this is why we think it's so accretive to build right now versus buy, because even though interest rates are very high, prices have remained incredibly strong in the asset class. So do you want to talk about that and then potentiality of cap rates compressing even further once interest rates come back down and institutional money starts coming back in?
Yeah, I think when you look at the Green Street data, it tells you that multifamily and office have taken the biggest hits in their valuations in the last, 12 months since peak pricing in like late 2021. Self-storage is in the top 3 for the least hit. Lodging didn't take much of a hit. And then mobile home parks and storage are really the 3 that shine during this time. And I think the reason why is because, lodging is just taking off. I think that's a great asset to be in. And mobile home parks have always been a great asset class. Very sticky, very consistent, and they're declining in actual count, right? The people are taking away mobile home parks. They're not really building them anymore. But storage, typically, the debt has been more fixed rate debt. The asset class has been the best performing over the last 40 years. And so I think when people look at recessionary times, self-storage does better, because it always relies on the 4 Ds, displacement, downsizing, death, and divorce, right? So those 4 Ds are always going to happen. And I think that the institutional money knows that this is what is a stable thing to be in during a recession. The other thing that we've found is that there just isn't the distress in self-storage that there is in other asset classes. Multifamily's got a lot of floating rate debt rises, and then the sellers get into a position where they can't, where they have to sell or even hand the keys back in, and that's creating a lot of declining values. Self-storage has not been that way, it really in the slightest. I mean, it hasn't been an asset class that's been under distress. So it's interesting. We're selling a lot of properties right now, 3, 4, maybe 5% cap rates, low quality assets, Gen 1 facilities. People are buying these and paying a premium for them. Even right now, and we've had properties sell just less than 3 or 4 weeks ago. And what's really telling is the industry. You got to think about it, if you're not familiar with storage, there's 4 major REITs in self-storage, 4 major publicly traded REITs: Extra Space, Public Storage, CubeSmart, and NSA. And there's only 4. There used to be 6. Life Storage just swallowed, or I'm sorry, Extra Space just swallowed up Life Storage, so that they combined to make 1. And I shouldn't say there's 6, there used to be 5. And Public Storage just consumed Blackstone's brand, Simply Self Storage. And those are the 2 largest publicly traded REITs, Public Storage and Extra Space. And you know what they're working through right now? Tate, you know this as a pilot, like, really, like, what happens when 2 airlines merge? It's just chaos, right? Like there's just, they're worried about payroll and who we're keeping and who they're, so those 2 REITs, they haven't even been buying for the last 5 to 6 months. They're pencils down. So if you think about how many people are buying when right now and how asset prices are remaining strong, when the biggest buyers aren't even really out there transacting because they're really consuming those 2 companies, just imagine in a year from now when they're actually pencils up and they're buying and writing contracts. That's just another influence that's just not there. So it just shows you how so many like private individual funds, institutional buyers, sovereign wealth funds, pension funds, endowments are actually active in the space, buying this product in a time when the REITs are just kind of asleep right now.
Yeah.
And so when we see interest rates drop, the REITs sort of get those Life Storage and Simply Self Storage mergers done, you're going to see they're going to come back on, and the asset values, I think, are just going to continue to go up, especially as interest rates, I think, are going to be tending to fall. Again, this is just conversation. This isn't like what I'm putting in the pro forma. I'm not projecting this to happen. We're just projecting sort of status quo. And we always project our cap rates to go down or go up, I should say, and get worse.
Yeah.
So we have that conservatism built into the fund. So
right. Yeah, and that's what is driving the projected numbers in terms of what we are conservatively projecting to investors. Again, everything is just a projection, but they're based on very conservative numbers and not taking into account all of this sort of optimism that Ryan's talking about for next year and in the future. Ryan, you've got $600 million in assets under management. What makes you excited about these specific properties? We've got 3 in the basket, and I'm hoping we can talk a little bit about the one that's on the horizon.
We can sneak peek at that a little bit. So,
okay.
Yeah, so I would say right now, if you can get $20 rents in a market, meaning that the price per square foot that you're going to charge on an average is going to be about $20, which is the Bellevue property, you can build it for less than what you can buy it. So even if asset values decline, we can actually build it for less than we can buy that property. So we can come in at $70, $80 a foot and build a property that can trade for $300 a foot. And even if prices go down 10, 20, 30%, you're still got a margin in there. And that's what I'm excited about. I'm excited about that for the Bellevue project, that we're building it for less than we could buy it. If you wanted to go buy a property in that market, you would have to, it's commercial real estate, right? So they would look at what the income is produced on the asset and what the cap rate would be in that market, and you would see a huge cost to build that property. So we're building that property for about $10 million. That property we would trade, for probably at least $19 or $20 million in today's market. So I like that our basis in the deal is really strong, allowing some market uncertainty to take place and some asset values to decline, to give us that wiggle room to still make a great profit on the deal. That's what I'm really excited about for Bellevue. The other thing that I like about that property is it checks every single box. 28,000 cars drive by that site a day. That means that you're going to have, your customers come from drive-by and they come from online. That's it. It used to be Yellow Pages and all that, which is why you see like AAA storage so they could get the highest ranking, right? But it's drive-by and it's online ads. So when you think about what makes a good drive-by site, 28,000, at least 20,000 cars a day is what I like to see. This one has 28,000. It's got 600 feet of width on the road. So it takes 10 seconds or so for a person to drive by, and they're looking at your property, right? So everybody knows it's there, and then there's easy access on and off. So I love that fact. I love that thing. And then I love that there's 3 times the national population growth surrounding that property. People, there's demand today, and that there will be demand in the future as people are continuing to move to that site. So I get excited. That's probably my favorite deal in the growth fund. The other 2 deals, I really like the fact that the P Ridge property, we've been operating that facility. That facility is about 110,000 existing. We're adding on 30,000 square feet. There's like 3 things I like about that property. Number one, 10 times the national population growth. So that market is just on fire. If you guys are familiar with Northwest
exploded.
Arkansas, it's growing, right? So like I want to be in a market where, you know, rising tide raises all boats. I want to know that there's tons of population coming in behind us because that triggers storage events. It's 9 minutes from the Walmart new world headquarters. So Walmart's not going anywhere. It's also in a market that has 3 Fortune 500 companies. So just, I love the demos in that property, and we've just had success in it. And then obviously the Kingsland facility, it's right by a military base, just north of Jacksonville. It's kind of considered part of the Jacksonville, Florida MSA. And there's 3,800 houses being built within 5 minutes of that property. I mean, I drove that site. It's like all new roads and sidewalks and houses coming up. You know, and even the guy we bought the property from, he's a home builder, and he thought, oh, it'd be a good idea to build storage. I heard about this storage thing. So he built it. We bought it from him because he didn't want to operate it, because he wanted to turn his cash over as soon as possible so he could go build more houses. So just the demos in that market are phenomenal. I think the average population growth is 6 times the national average. And then just the lease up we've seen. Property's pretty small. It's not
Yeah.
You know, a huge property. We're gonna deliver a total of 50,000 square feet there. But so it's just a nice little market. The new
That's
deal, if you
Yeah,
want
let's hear about the new one.
Yeah, it's in our backyard. You know, I love the Pacific Northwest. We've already got a Class A portfolio in the Pacific Northwest, and you know, it's on Whidbey Island. It's right by the Naval Air Station there. Know a lot of pilots based out of there. That's where they filmed, you know, some of Top Gun, Maverick, right off the air base there. So that's pretty cool. Market rents are $25 a foot. That's exactly what we want. We really beat the seller up. I think we started at like a $3.5 million purchase price for the land, and we've got it down to 1.8. We just kind of keep walking away from the deal, and the deal keeps coming back to us. So we really like that. We're going to build about 75,000 square feet, which is the perfect amount of self-storage for that market. There was a U-Haul that was recently built, and that kind of made our feet a little bit cold initially, but they've already leased it up. So we're kind of like, okay. I mean, the market is so strong with rental rates and demand that we really like that. It's right off a main road, really good demographics. It's actually in a town called Oak Harbor, Washington. And we're just really excited. I mean, all of our Pacific Northwest deals, I mean, I know, Suja, I think you're in our Sandy deal. You know, that deal has leased up, you know, 65, 70%. Really fast, and we've like very little competition, very great, you know, good high $25 rents. I just like it. I like building high quality assets in the Pacific Northwest that are going to last a long time, and they're going to get great rents, and you're not going to have a lot of the volatility that you see. So that's some of the high notes. I have a webinar that I'm getting ready for on Thursday to talk about it as well. But you know, excited about that one. Yeah, go ahead.
Excellent. Well, hey, this was supposed to be a you know, a quick and dirty 20-minute update. So we're already over on time. We can probably go a few more minutes if anybody has any questions. Feel free to pop them in the chat or raise your hand. Otherwise, you can reach out to myself or Suja. We'll get all your questions answered. Really excited about this one, Ryan. Thank you so much for joining us today.
Yeah. I think just one thing to touch on, Ryan. I know you kind of already touched on it, but just reminder of jumping into a development deal at this phase, and like why that mitigates risk for investors coming in now.
Yeah, I would say that the riskiest thing you can do in real estate is get involved in a development deal. You know, not to sober, you know, my excitement, but you know, that, you know, when you think about risk return, the bigger risk you take generally should mean you get a better return. And so that usually means the property doesn't have any permits or entitlements. It may be zoned for storage, but it doesn't have the approvals to actually build what you intend to build. So if you can't build what you can't intend to build, then what do you do with the property? Well, you're going to have to sell it, and that could take a very long time. So at this stage, we have all of our entitlements. We have all of our permits. So then the next thing is, you know, contractor's risk. You know, prices could go up, and you know, and all this other stuff. Well, we've already locked in all of our bids, so we know exactly what our costs are going to be. And then building risk is always inherent in a development deal. But again, you're kind of like lowering the risk as you go. P Ridge is already built. Bellevue is already pouring foundations. Obviously the Kingsland deal is already leasing up. So that's probably, that's been de-risked considerably. And then the last part of the risk in a development deal is the lease up. And Tate alluded to that earlier, with Kingsland being 50% leased, that's, already de-risking that asset. The P Ridge property, which is great, it's already leased on the 110,000 square feet. So the 30,000 square feet, we're just going to lease up. That's the risky part. And, but we're confident that we're going to be able to lease that up based on the demand. And then Bellevue, we're going to lease up. But we've given ourselves so much runway. We've given ourselves a 3-year runway to lease up that property. And we've baked that into the financials. So I think we've got plenty of time to lease that property up. We gave ourselves a year to build it. We're going to build it in about 6 months. So we're already ahead of schedule there. And then we gave ourselves 3 years thereafter to get it to stabilized occupancy and are carrying the cash to do that. So, I think that, from a risk standpoint, yeah, if you talk to me in April, I'd say, hey, there's a risk in, entitlement and permitting and all this stuff. But I think that's all been sort of put behind us at this point.
Yeah. Awesome.
Amazing.
Thank you.
Well, thanks, Ryan. If there's nothing
welcome.
else, we'll close this out and keep it short and sweet. Thanks everyone for joining, and we'll see you on the replay or after the fact.
All right. Thanks, guys.
Cheers.
Thank you. Bye.
All right. Take care. Bye.
Thanks again.